Everyone wants upside of investing, but no one wants to pay the price of admission. Take a moment, think about the last time you saw your investments drop. How did you feel? What did you do? I get it. Watching your portfolio drop isn't easy, but the best investors learn to control their emotions, not react to them. If you've ever struggled with this, you're not alone. Let me ask you something. How many times have you thought about selling your investments when the market was crashing? If you've ever felt that urge, you're not alone. But let me explain. When we think about risk, our minds go straight to big crashes. 1929, 1987, 2000, 2008, 2020. Panic, fear, and catastrophic losses. But here's the truth. Risk is always there. Right now, we are 16 years past the 2009 low. The S&P 500 has gained over 1,000%, but that doesn't mean it's been an easy ride. Think about this. Since 2009, we've seen 30 market corrections over 5%. Of those, 10 of those were bigger than 10%, and 4 of them exceeded 20%, and only one dropped more than 30%. Still, would you hold on? Ask yourself, if your portfolio dropped to 20% tomorrow, what would be your first reaction? Would you stay calm or would you feel the urge to sell? Here's what happens every time the markets drop. The headlines scream, recession. People predict the next Great Depression. The world's biggest investors freeze hiring. You feel like the sky is falling, and yet the market recovers every single time. The thing is, no one has successfully timed their way out of these declines and back in the right time. It's impossible. And trust me, I've seen this over and over again. Studies show that the average investor significantly underperforms the market due to emotional decision making. The Dalbar quantitative analysis of investor behavior found that the average equity investor earns less than half the return of the S&P 500 due to poor market timing. In fact, did you know that missing just the best 10 days in the stock market over the past 20 years could cut your returns in half? It's pretty crazy, right? I remember sitting with an investor back in 2020. The market was in free fall and he convinced it was all over. He called me in panic and said, Ahmad, I cannot take it anymore. I have to sell. I tried to reason with him, but fear had taken over. He sold everything at the bottom of COVID. And by the time he felt safe again, the market had already recovered. His portfolio never caught up. Fear is expensive. According to the JP Morgan Asset Management, an investor who has stayed from 2003 to 2023 in the S&P 500 earned an average of 9.8% annually. But missing just the 10 best days reduced that return to 5.6. So what does that mean for you? Take a second. Are you investing in a way that truly matches your ability to handle losses? Risk is the price you pay for the possibility of long-term returns. Since 1928, the S&P 500 has delivered roughly 10% annually. Bonds, 5%. Cash, 3%. And after inflation, stocks are still the clear winner. Why do stocks pay more? Because they're riskier. You earn a premium for handling uncertainty, for stomaching losses, and staying in the game. Let's talk about something most investors won't tell you. Risk tolerance is not about percentages. It's about real money. A 50% loss on $10,000, that hurts, but you can recover. A 50% loss on $1 million retirement account, that's life-changing. I know this firsthand. Early in my career, I took a position that I thought I could handle. Then came a steep market drop, and suddenly I wasn't so confident. I stared at my portfolio, watching red numbers pile, and questioning everything. That moment taught me knowing your true risk tolerance before a downturn is crucial. Most people think they can handle risk until it happens. The key is preparing before the storm, not during it. So, what should you do? Before I share these 3 key steps, think about your own risk tolerance. Are you prepared for the next downturn? First, know your real risk tolerance. If you can't stomach $500,000 loss, then don't invest like you can. Second, expect drawdowns. A 10% drop happens every other year, a 20% drop every 4 years, a 50% drop every 19 years on average. That's just how the market works. And third, stay invested. Uncertainty is not a bug in the system. It's the feature that makes long-term investing work. Just look at the great financial crisis of 2008. By March 2009, the S&P was down nearly 57% from its peak. Many investors sold in panic, yet within 5 years, the market doubled, proving that the best gains often follow the worst declines. Let me dive in and let me give you an example. Imagine 2 investors, one who fully stays invested and one who tries to time the market. Investor A stays in through every crash, ignoring the noise, and sees their portfolio grow steadily over time. Think of Warren Buffett. He's famous for saying the stock market is a device for transferring money from the inpatient to the patient. Investor B sells every time there's a bad news, trying to avoid losses. What happens? They miss the best recovery days and the returns lag significantly. The numbers don't lie. The best days often follow the worst ones. If you're out of the market, you miss them. The best investors don't avoid risk. They understand it, prepare for it, and most importantly, stay in the game. Now, if you want to dive deeper into how family offices manage risk while building generational wealth, hit that subscribe button. And if you've ever been tempted to sell in a panic, drop a comment. I want to hear your story. See you in the next one.